The US has very much dominated the markets over the past decade, but if you have a look at, say, October last year, that was where the inflection point really started coming. Dollar weakened, emerging markets started moving, and if you look at it from there, a company like Apple, Amazon, down 15% from there, but a company like Tencent, Alibaba, up 80-90% from there. So when we're in a low return but volatile environment, the opportunity to make excise returns in some of these dichotomies that you've got between these different markets is really quite phenomenal.
So that's happened. It's begun to happen 2.5, 3 months ago. Is it still going to happen in 2023? More of the same? Because by nature of the trade you just mentioned, it is stunningly volatile on both legs.
I think that you've got to ask yourself, what's the re-rating potential of some of these large cap stocks in the US, especially if you think about also companies like Pepsi is on 3% free cash flow yield. It's so expensive. Company like Amazon, Apple, they've come down quite a lot relative, but they're still looking quite overvalued, really. But if we look at China, the bad news was so bad, and we really had people calling the market quite uninvestable through the middle of last year. And so yes, we've had a large move, but in those certain subsectors like online gaming, for example, I think we're seeing still some interesting opportunities from a valuation perspective.
Right. What was interesting about the market yesterday was the Nasdaq actually managed to eke out a positive performance against the declines we saw for the other two indices. And I wonder if that is a reflection at all that there is a growth investor still out there who wants to reinvest in American tech at this point. I know you've been a long-term holder of Microsoft. What are your views on the opportunity here to re-enter some of these growth trades for this year?
I think that there is still a lot of people who think that what happened over the past 10, 12 years will continue to work. I think there's still some buy the dip mentality. I think that there are some really interesting opportunities in the US. Certain subsectors of the US, like healthcare technology, for example, really interesting. Companies like Edwards Life Sciences, for example, went down by almost half last year. And you've got opportunities to enter into structural growth companies at what more compelling valuations than you've had over the past, say, 4 or 5 years, or in some cases longer. But I think you have to be careful about what parts of the market you're looking into.
Interesting. I mean, Yum Brands has been another of your long-term holds, but you've actually been taking down some of the position. I read from your notes here. Yum is a sort of Chinese fast food play, ultimately. Is that you figuring out that as they reopen, we'll see the same kind of phenomena occur that we saw in the rest of the world, that some of those lockdown fast food businesses actually came off quite aggressively as part of that whole shift in the COVID-related trades? Or is it about something else? Because I know you've been in for a long time.
So Yum China is really interesting because I think the market is very quick to discount the Chinese reopening. And for them, they've got an exceptional growth story going to thousands of cities in China that don't have any KFC stores. But the reality is that company has got heavy capital expenditure and they are investing for growth. Now, that's really exciting over the long term, but over the short term, when you've got a name that has, by some margin, outperformed a very weak market over the past year, and it's up about 50% since the end of October, you've got to ask yourself, if you're following your valuation discipline, where to from here. So we just take that position back a little bit, and we have been invested, like you said, in Yum Brands, which is the US sort of counterpart of that for well over a decade now.